Hi friends, my name is Dr. Nasrin Safabi. I am an internal medicine specialist here in Toronto. For the last 2-3 years, I have started a campaign in physician wellness, and it was not long after starting I realized financial health is an important part of wellness. During this journey, I met with wonderful people, including Joel Mixa, who helped me with corporate and estate planning. Here I am with Joel to educate you regarding family trust. Hi, Joel. Thank you for helping us.
Good morning, Naz. Thank you for letting me participate.
So we are going to start talking about family trust today. So I would like to first introduce yourself a bit and talk about your role in estate planning and corporate planning.
Okay, yeah, so as Naz mentioned, my name is Joel Mixa. I'm a barrister and solicitor licensed in Ontario. I'm originally American from Chicago, Illinois. So I started my practice down there about 18 years ago now. Practiced down there for about 10 years, and then I came up here, got married to a Canadian, so that's why I'm here. Took the bar exam in Ontario, and I've been practicing in Ontario now for 8 years. My practice focuses around the area of real estate and business transactions, so buying and selling residential real estate, commercial real estate, buying and selling businesses, forming businesses, corporations, doing joint venture agreements, and then also estate planning, which is where the trusts come into play, as well as doing wills and powers of attorney. Generally, those are all part of a large estate planning package for clients.
That's amazing. I should add, Joel is married to a physician. That's why he knows better than other people.
Thank you.
So how about we start? So can you just teach us a bit about the family trust? What is a family trust?
Sure. Let me just share my screen with you because I have a summary of all the points.
That's amazing. Thank you.
So can you see that?
Yes, that's perfect.
Yeah. So family trusts. First question is, what is a family trust? A trust is used to transfer administration of property from one person, who is the settlor, to another person, the trustee, and the trustee holds that property for the benefit of a third party, the beneficiary. So basically, once you transfer property from the settlor to the trustee, it's no longer the property of the person who transferred it, the settlor. It's no longer their property. Once you set up a trust, other people can also contribute property to the trust, and then the trustee holds that property as well for the benefit of the beneficiaries. One of the big reasons that most people use family trusts is because it provides flexibility in the terms of taxation and estate planning. So then there's three main players essentially in any family trust. As I mentioned, a settlor is the person who creates the family trust. So the trust instrument is created, it's an agreement or a document. The settlor makes a contribution to the trust. Typically it's some fairly nominal financial contribution. One thing to keep in mind is that a trust is not a separate entity. It's more an arrangement between parties. So typically the trustee, or the party who is the trustee, is the one who has the plan for the trust. That would be, let's say Naz is our client here. Naz would be the one who wants to set up a trust for the benefit of her children. So what you can do is the settlor is typically a friend or a family relative, as long as they're not somebody who's interested in or would be taking under the trust. So that settlor contributes some property to Naz to hold as trustee for the benefit of the beneficiaries. And as I mentioned, once the family trust is set up, then anyone else can contribute property to it. The trustee is the person who's entrusted with administering the property.
May I just interrupt you just here? So settlor does not have any, besides just kind of helping you forming the trust, does not have any active financial role in the trustee. Is that right?
That's correct. They're basically, typically they're kind of what's known as a straw man. They're somebody who is there for purposes of making that initial contribution. The big issue there is there are tax rules that they're known as the attribution rules. So you don't want to have the trustee also be the person who makes the initial contribution of property to the trust, because the CRA may rely on the attribution rules to say, well, there was no real transfer from a third party to the trustee. It's just the person who's a trustee taking something from one hand and putting it in their other and calling it somebody else's property. So in order to avoid those attribution rules, you typically want the settlor to be, like I said, a third party who's unrelated to the settlor, or they can be related, but they're not going to be somebody who's a beneficiary of the trust or have any interest in the trust going forward. So the typical contribution from the settlor is either a loan to the trust, and that can be memorialized by a promissory note, which the trust can then later pay back once there's actually income to the trust, or if gifts are made from someone else to the trust.
And in terms of the nominal amount, how much is usually involved for the settlor? Is that a lot or just a kind of a minimal?
Anywhere from $100 to $500 is kind of the
routine.
Yeah, the routine. The contribution can also be cash from the settlor to the trustee, but then there's always that possibility that if the CRA was really aggressive, they may say, well, where did that $100 come from? So if the trustee actually gave that money to the settlor just to give it to the trust, you may not be able to get around those rules. That's why the promissory note approach is one of the more reliable ways to establish that it's not really, it's completely separate funds that were contributed to initially start the trust. Because that's one of the requirements to form a trust, is there has to be a contribution to it at the time that it's formed.
Sure, thank you.
Yeah. So yeah, then coming to the trustee. So a trustee is a person who's entrusted with administering the property in the trust. So they hold title to the trust property, because again, a trust is not a separate legal entity. It's not like a corporation or some other business entity. The trustee holds title to all property for the benefit of the beneficiaries. So as you can see from my notes, trustees manage the property held in the family trust, and they decide how it will be distributed to the beneficiaries, but they have to act in accordance with the terms of the trust document, which sets out the trustee's responsibilities. So again, we'll get to the trust agreement, but it's typically a document that says the settlor is forming a trust, they contribute X to the trust, they are appointing, again, Naz is the example here, Naz is being appointed as the trustee. You can have multiple trustees as well, and sometimes that may also help with the minimizing the possibility of the CRA arguing that the attribution rules would apply. So sometimes we do 3 trustees in order to very clearly establish that the trustee does not have sole control over the assets of the trust. Again, you don't want the CRA relying on the attribution rules and disregarding the trust and saying, well, there was no real trust here, and the whole thing is a sham. Essentially, we're going to disregard it. So let's see. Yeah, and that's what I mentioned here. The settlor may appoint themselves as a trustee, but it's not recommended due to the tax attribution rules. Then the third party or group of people who's usually involved in a trust is the beneficiaries. So these are the people who are entitled to receive the trust income and capital. Typically, they are the spouse and the beneficiaries of the trustee, and then they can be further issue and other relatives of the trustee if the trustee, well, the party who's having the trust set up, if they desire to name those people as beneficiaries.
May I interrupt you here? So if just I think for most of the physicians, they are incorporated. So they do have the medical professional corporation or the sister companies and holding companies. How you can just put those in trustee? Is it possible or is not? How we can just connect them together?
We will definitely get to that. I have more points on that down below.
Sure.
But yeah, certainly there are mechanisms to move assets that may already exist into the trust without incurring tax liability. That's always the key thing, is trying to minimize any current tax liability. So we'll get to those options or those possibilities.
Another question that I have, if trustee could be beneficiary too or no?
I'm sorry, what was the question again?
If trustee could be beneficiary too?
Oh, yes. Yeah, so that's one of the trust instrument it has the initial points I mentioned, and then it has the distribution provision. So typically most trust instruments have a distribution provision saying that, let's say, as you're the trustee, you're also going to name yourself as the beneficiary. Your spouse and your children can all be beneficiaries of the trust. And typically what the trust instrument will say is the trustee has discretion as to how much income from the trust or how many assets the principal of the trust can be distributed out to the beneficiaries and to which beneficiaries. So during your life, you would probably direct, to the extent there is income from the trust, and to the extent you want to distribute it from the trust, you can direct it to yourself solely, or you can direct it to just your child, or if your spouse may be in a lower income tax bracket, then sometimes it may make more sense to distribute some of the income to your spouse. And then he pays tax on that at his own personal income tax rate. The CRA's kind of changed the rules over the last several years. So that used to be known as income sprinkling. It's a little, there's less tax benefit to doing that these days, is my understanding, but that's one other approach to how to maximize the tax benefits of the trust. And then with regard to the distribution provisions, typically once let's say you're the trustee and also the primary beneficiary, there's often provisions in the trust agreement that says once you pass away, then the income and the principal of the trust can either be held in trust subsequently for the benefit of your spouse and your kids, or it can be distributed out to them. Let's say that your child is an adult at that point, no longer a minor, then all the assets can be distributed out to them. But that is another benefit of trust, which I'll mention again later, is that it can help hold assets for a longer period than essentially they would otherwise be entitled to, in the sense of if your kids are 18 and they received all the assets of the trust, it could be a lot of money all at once. And you may not want that. So you can have staged distributions of the assets of the trust, whereby, let's say, a quarter of the assets of the trust or the value of the trust can be distributed out to the child when he turns 21, another quarter when he turns 25, and then the balance at 30. So you can do staged distributions as well.
Amazing.
Yeah. So potential benefits of a family trust, reducing the tax burden. So as I mentioned, once the assets are put in the trust, it's no longer the trustee's property personally, or whoever, the settlor, the trustee, anyone else who contributes property to the trust. It's no longer their property. It's an asset of the trust. So income flows into the trust, and then it can be distributed, or it can be distributed out to the beneficiaries, or it can be held in the trust. If you hold income in the trust, then the trust has to file an income tax return, and it pays tax at the highest marginal rate, which is not a great tax result. But as you can see from my notes, and I mentioned before, you can income split and sprinkle income to multiple beneficiaries is one way to potentially flow income out to your family members at a lower income tax rate. Alternatively, one of the other things that most people do with family trusts is they have a corporation that is owned by the family trust. Excuse me. So that corporation owns the actual investment. Money flows into the corporation. The corporation pays tax on it at the corporation's tax rate, but then the corporation holds that money in the corporation, and it can then redeploy that income back out to some other business venture, either through a loan to another corporation that's also owned by the trust, or it can just hold it in the corporation until such time as it makes more sense to distribute that income from the corporation to the trust, at which time it would flow out to the beneficiaries. So in, let's say, your case, right now you're a practicing physician, but once you're winding down your practice, getting close to retirement age, or you're just not as busy, but if you manage to build up a large amount of wealth in that corporation that's owned by the trust, then you can start flowing that income out from the corporation through the trust yourself. And if you're not making as much money from your current income, then your tax rate will be lower. So it's kind of a long-term retirement plan as well, to try to keep money in that corporation that's owned by the trust and only flow it out when you really need it and when it makes sense from a tax perspective. So reducing taxes payable at death. So this kind of goes to your question in terms of if you already have a medical corporation or any existing corporation, there are ways to transfer the assets to the trust. We do those through a share exchange that involves what's known as a tax freeze. So there's provisions in the Income Tax Act that allow share exchanges either between an existing corporation and a new corporation that we form that's owned by the trust. And we do share exchanges so that the corporation, the new corporation, ends up owning the shares of your medical trust, or at least some of those shares. With an estate freeze, that's actually an internal reorganization where you would retain shares representing the current value of your corporation. Let's say you have income built up in there or other assets that already have value. So we do a share reorganization, issue new shares to you that lock in that value that's already there, and issue new shares to the family trust, so that as your medical corporation continues to practice, or as you continue to practice and it receives income, you can flow the value of that income through to the corporation that's owned by the trust, to try to move it over there instead of just to yourself. So that's a little bit more complicated tax maneuver, but it's something that we can do in terms of how to get that income from your medical corporation, which is solely just yourself probably, to the family trust.
I have a question here. So because I think there are some liability with our medical corporation. If that's going to be transferred to the family trust as well, or no? So they are a separate entity, and those liability on our medical practice is not transferable to our family trust.
Yes, your medical corporation should shield essentially the liability of your medical practice is limited solely to whatever assets your medical corporation has. So the trust would not be liable for the actions of your corporation, even if it did own some shares of your medical corporation. It does not have liability. That's one of the reasons you use a corporation, is because as long as you follow corporate formalities, you don't commit fraud, you have to maintain separate bank accounts, you have to file your annual returns, tax returns, you have to treat the corporation as if it really is a separate entity and follow all the protocols you would. If you don't, then you can potentially lose that limitation of liability. But yeah, in general, the liability of each corporation is isolated solely to whatever it owns. So if there is a creditor of the corporation, they can only recover assets of the corporation. They cannot go behind the corporation and get assets from you personally or from the trust, whatever the case may be. I thought what you were going to ask there is, with your medical corporation, you're probably familiar with the fact that in Ontario, at least, a medical corporation, only the practicing physician can own common shares. They're entitled to voting rights, but you can issue non-voting shares to your family members or to a trust that is for the benefit of your family members. So those are non-voting shares, so that your family members and the trust have no ability to control the medical corporation, but at least they're shareholders, so that, again, if you have discretion in your medical corporation as if the dividends, if you have discretion as to the dividend flow, then you can flow some money to those special shares that are non-voting, which are held by either your family members or up to the trust, so that money comes out of your medical corporation and moves over to the trust, so then it can be repurposed or utilized for other investment activity.
Amazing. You mean in the family trust, not in the actual medical corporation?
Right. Yeah, that money flows from your medical corporation because of the special shares that you issued. Again, that would be pursuant to the Section 86 share exchange that we would do. It would be an internal corporate reorganization. We would issue some special non-voting shares, probably to the corporation that's owned by your trust, so that money could flow tax-free between your medical corporation to that. It would essentially be a holdco, the new corporation owned by the trust. and then that money is in that holdco corporation to be utilized for some other investment activity.
Sure. Great. Thank you.
And then again, you're mentioning you weren't sure with the medical corporation and the relationship of sister companies. So with your medical corporation, it's the same idea kind of as the corporation that's owned by the trust. Your medical corporation, you have income, and especially with a medical corporation where you get the benefit of an operating company. So I believe you pay a lower tax rate on the first, I think it's the first 400,000 or maybe 500,000 now of income to a corporation that has active income. So you may pay tax at a rate between 11 to 13% on the income to your medical corporation. And then you flow that up to the holdco without paying tax on it again, right? So, and alternatively, if you don't have the holdco, the idea with the medical corporation is that money flows in, you pay income tax on it when it comes into the corporation. But ideally, if you don't distribute it out to yourself for all of your own living expenses, then it can sit in the medical corporation until, again, you get closer to retirement age and you're ready to start pulling that money out. Your active income is less at that point, so your tax rate would be, you're probably not paying as high of a tax rate. But in any case, so if you have money that's accumulated in your medical corporation, if we don't do the share exchange and flow money that way, what you can do is loan money from your medical corporation to the holdco that's owned by the family trust. And that's another way to, at the end of the day, the holdco has to pay the loan back to your medical corporation, but it is a way to utilize the money that you've built up in your medical corporation and invest in something else without necessarily having that investment be owned by your medical corporation. Because there are restrictions on what a medical corporation can do and what it can own.
Amazing. Thank you.
Another reason for using family trusts is to avoid probate. So one of the key things is in Ontario, estates are required to pay estate administration tax. It's not a huge tax. It's $1.50 per $1,000 on any amount over $50,000. But at the end of the day, it is still a tax. And if you can avoid it, it's preferable to avoid paying it. So once you transfer property to a trust, then the assets of that trust do not have to go through probate. Instead, the trustee or the successor trustee can simply, upon the passing of, I'm sorry, Naz use the example, but if you were the sole trustee during your life, you pass away, your trust instrument is going to say, well, then my spouse becomes the subsequent trustee. So then your spouse can immediately take over any of the assets that are owned by the trust and deal with administering them. He doesn't have to deal with probating the assets of your estate. Doesn't have to pay that estate administration tax or anything. There's also no death tax or deemed disposition is what they call it on your passing with respect to the trust assets, because again, going back to that initial concept, the assets held in trust are not really your assets. They're assets of the trust that are held for the beneficiaries. So planning the transfer of your wealth, again, basically, they're typically used to pass on wealth within the family. As I mentioned, the disposition provisions typically specify who should get the money, what it should be used for, whether it's during the settlor's lifetime, the trustee's lifetime, or after your death. And as I mentioned also, it can prevent children from getting money too early and spending all their inheritance when they're not really ready for receiving that kind of income for assets. It also protects your assets, again, because the assets are held by a trust are not yours, then your creditors cannot go after the assets of the trust.
Before we go, can I just summarize it quickly? So what
Sure.
we discussed so far, we have talked about what is the family trust and what are the components of the family trust, settlor, trustee, and beneficiary. And we went through the benefits, the potential benefits of a family trust, reducing your tax burden, reducing taxes payable at death, and So I have the rest. So avoiding probate, planning for transfer of your wealth, and protecting your asset and protecting your children.
Yes.
So is anything I missed, Joel, here?
No, that's all the major points and benefits of using a family trust.
Perfect. So now we are going through, I think I'm assuming, this advantage of family trusts.
Yeah, there are a few disadvantages. So one of them is the 21-year rule. So the CRA deems all the assets of a trust to be disposed of 21 years after the creation of the trust. So what that means is, from a tax perspective, whether or not the trust actually sells anything, the trust is deemed to have sold all of its assets at once, and all of the capital gains on that trust income has to be taxed. So let's say that the trust owns a corporation, and that corporation owns a piece of real estate, income producing real estate. During the time that the the real estate has been owned by the corporation, the rental income has flowed in. Perhaps you've used that money to invest in some other investments, or you've floated out to the beneficiaries. But really what this is looking at is the appreciation in the value of the real estate. So you need to get an appraisal of that property and determine what the value is on the date, the 21-year deemed disposition. So it'd be the difference between what you paid for it plus any renovation costs that you've done on the property, anything to increase your cost basis on that property. But basically, you'd be looking at what you invested in the property and what is it worth on the 21-year deemed disposition. And then the trust would have to pay capital gains on that difference, or rather the appreciation in value. So it can be quite significant if property has appreciated a lot over 21 years, which it certainly has in Toronto. So there are a few ways to deal with that. One of them is, if you already have a corporation in the trust, then you can potentially set up a new family trust with a holdco, and you can do a share exchange, just like I mentioned before, and exchange the shares of that corporation potentially for shares in the new trust owned corporation to move the assets out of the family trust so that you don't get hit with that tax bill. Or you can just sell the property and distribute the money out to the beneficiaries. That way, at least if the beneficiaries are children, let's say, then they may be in a lower income tax bracket. So then you're not going to get hit with the highest marginal rate tax on the disposition of those assets. Or at the end of the day, let's say if the asset hasn't appreciated that much, you may want to just take the hit. You get the appraisals done. The trust pays the income, the capital gains on the appreciation of the property, and then the trust continues on, and you're good for another 21 years. So there's that option too. Not the most tax efficient necessarily, but it also depends on the nature of the assets that's holding and how much they've appreciated in value.
And likely it depends on where state you are in your life too, right? So if you're closer to retirement, or you were still active physician, so likely continuing with the family trust or taking the assets out would be a solution too.
Yeah, it's definitely something that you would talk to your accountant about, because as far as the income and tax consequences, that's something I always defer to the accountant, and clients should speak to their accountants in terms of planning those steps. So with the 21-year rule, it is one of those things where, again, using you as the example, in 21 years, hopefully you're looking at retirement, or at least not practicing as much. So if your assets in the trust have appreciated and you want to work less, you may be able to start flowing out some of that income, or rather, the built up income, rather, you can start flowing out to yourself maybe over the first 5 years before that 21-year period is up. Every year you flow out or start selling assets and flow out the income to yourself, and then you pay tax at your personal rate, as opposed to leaving that money in the trust and having the trust pay the highest income tax rate.
That's kind of basically, we're just kind of hoping with this family trust, we have some passive income during the time we are kind of involved in our medical practice. So, and that can we take away that passive income, hopefully when it's a time to slow down and just closer to retirement.
Yeah, and that's one of the key reasons why you want to use a holdco in the trust, so that you can control the timing of the distributions and the tax consequences of the income flowing into that corporation. If you own property directly in the trust, let's say the trustee holds title to a piece of real estate, then there's no way to shelter the timing of the income from that real estate. Essentially, the trust is going to be deemed to have received that income. So the trustee then either has to distribute it all out to the beneficiaries and they get taxed at their personal rate, or the trust just pays tax on it at the highest marginal rate, which is not great tax planning. So that's the main reason why you typically want to have at least one corporation that acts as a holdco that's owned by the trust to control the timing of those distributions. Then that holdco can own subsidiary corporations, or it can hold other assets such as brokerage accounts, bank accounts, can hold like artwork, other assets that appreciate, again, to allow you to hold them and wait for them to appreciate, and then later sell them and flow that income out when you're ready to receive that income.
Before we move on, so can you just explain one more time, what we can keep in the family trust? So the real estate investment, it's anything else can be held in the family trust?
Yeah, a trust is essentially can hold any assets that a person can. So I do have that down here. Let's jump ahead a little bit. So what assets can be held by a trust and what you can transfer to them. One of the key ones, obviously, is real property. As I mentioned, in most cases, it's preferable to hold the real property through a holdco, which is in turn the shares of that holdco are owned by the trust, so that you can accumulate income from the property in that corporation without having to distribute it to the beneficiaries and or pay tax. If you have multiple pieces of real property or intend to buy multiple parcels of real property, then I would probably have the holdco own shares of a subsidiary corporation and have each subsidiary corporation own a separate piece of real estate. Again, with the idea of isolating the liability for each property to that subsidiary corporation, so that you never know if there's some creditor of that corporation that owns a piece of property. Personal injury is a big liability, although you're going to have casualty insurance in place, home insurance, but you never know. Let's say there was a catastrophic event and there was claims of wrongful death or something, there may be lawsuit with a claim that exceeds the amount of insurance coverage. Or if you don't have insurance, rather if insurance is not willing to provide coverage, then at least you have that ability to try to isolate that liability to just that one corporation that owns just that one piece of property, so it doesn't affect your other assets owned by the trust. Another major item, as we discussed, is shares of a company or a corporation's shares. So as I mentioned, typically we form a new first we do the trust, then we form a new corporation. We issue common shares to the trust, and we'll also issue special shares to the trustee on a personal level. And those shares have discretionary dividend provisions, so that the trustee can make, or rather, the directors of the corporation have discretion whether to flow income to the shares that are owned by the trust or to you as an individual. So let's say your holdco, 50% of the shares are owned by the trust, 50% are owned by you personally. In a given year, let's say you actually want to or need to have money in your pocket, then the rental income, you may decide as the director of that holdco, you may decide to flow all the income out as dividends to yourself personally, because you actually need to use that money in this year. But we'll also have share provisions and a share structure that allows you, let's say you don't need any money in that year, which is the ideal approach, then you would flow all of that money to the special shares, or rather to the common shares owned by the trust, so that money accumulates in the trust rather than flowing out to you and being taxed, and then it no longer has the benefit of growing in the trust, so to speak. So again, if you're able to accumulate income in that holdco, that new corporation then can use that money to buy new property, other businesses, it can make other investments. And then, as I mentioned, if you already have investments through a corporation or a medical corporation, Then there's these provisions in the Income Tax Act that allow tax-free rollovers through share exchanges, whereby we either exchange shares of the holdco and the existing company, or we do an internal reorganization of the existing company and issue some new shares to the holdco. Some of the other assets, vehicles, if you, let's say they're more like collectors or antique vehicles, perhaps, again, you're looking for assets which are probably intended to appreciate. Works of art, collectibles and heirlooms. You can have a bank account, and in fact, that's one of the steps that you would typically take when forming a trust, is to open a bank account so that the trust can actually hold money, because it will need money for certain annual expenses. And then the trust, or rather the corporation owned by the trust, can also hold brokerage accounts holding shares on share exchanges and other kinds of investments as well. You can do private mortgages if you wanted to, or other kinds of loans as well out of the corporation. So those are all different kinds of investments, or assets rather, that a trust or the corporation owned by the trust can hold. We kind of skipped ahead, but a couple other disadvantages, or at least considerations, when using a family trust is that there are administrative requirements. So as I mentioned, there is the need to prepare and file a tax return every year for the trust. It's a T3 return, so it's an information return, unless the corporation is actually paying income tax on income. So again, you're going to have some accountant's fees on an annual basis that the trust has to pay. It may also have legal fees as well if there's a corporation, although at the end of the day, then the corporation would probably be making those payments, and it would be deducting those expenses out of its income. Record keeping, so there's no specific requirements to record keep, although trustees should document their work so that there's at least some account of what they did for the trust. They also need to take minutes of their decisions, produce financial statements. Again, this ties more into the income tax obligations.
Just a question here. Do we need renewal for the family trust? The renewal fee, like just a sister company in a kind of holding company or MPC? So because I think they are annual renewal for those companies. Do we need it in the case of the family trust or no?
No, the family trust, the only annual obligation is the income tax returns. Now, certainly if there's some activity that the trust undertakes as far as a new investment and there's legal costs that are involved, then you may pay those fees out of the trust. Although, again, if you're using a corporation, ideally, then the corporation is the one that's going to pay those bills and deduct those legal fees as an expense of the corporation, rather than having the trust pay those bills. But to your points about annual obligations of a corporation, yes, a corporation does also have to file annual tax returns. And it also, as far as Ontario corporations go and Canada corporations, there's an obligation to file an annual return. It's more of a information statement. Again, it simply just confirms where the office of the corporation is, who the directors are, who the officers are. Ontario recently changed its approach to those annual return filings. They used to be done as part of the income tax return, but now they've changed it over so that it's done through a Service Ontario portal, which is something that we also assist clients with now. Since that change in the system, we'll go in and help with filing that annual report, because it's a little confusing the way that it was.
It is. So many things, so many emails from different people. Yeah. So then just likely the only real disadvantage of a family trust is the 21-year rule. So then at that stage, you should be clear what you are going to do, because the other things is mostly the administrative and the record keeping that hopefully we are on the top. That is just likely the most major obstacle all the time, but hopefully we stay on top of the things with having good lawyers and accountants.
Yeah.
So then, sorry, could you just walk us through how to create a family trust and what are the steps we have to take if we decide to go ahead?
Sure. So as you can see from my bullet points here, some of the questions you should ask yourself and that we will ask in order to draft the trust agreement or instrument is, what objectives do you hope to achieve by creating a family trust? So that is usually with respect to the distribution provisions, as well as what do you intend to invest in or have the trust? What kind of assets do you want it to hold? You need to identify who's going to be the settlor, the trustees, and the beneficiaries. Certainly, if again, using you as the example, you may want to just be the sole trustee, but if you do want to have other people participate as co-trustees with you, then you need to be aware that they also are obligated to assist with the income tax filings. So you're going to have to talk to your friends and make sure that that's some role they actually want to take on and be involved with, because it does put liability on them as well. So something to keep in mind there. As I mentioned, what property will be transferred to the trust. So that can either be existing property that you're going to transfer, and how will we get it into the trust without incurring tax, or what other people do you know who will contribute property to the trust? So relatives, grandparents, let's say they have assets that they want to give to the kids, but they don't want the kids having possession of them yet, then the trust may be a mechanism to have them give assets or give something to the trust that can be held in trust for the kids. And then which trusted experts can you assist with the process? Certainly the lawyer is the one who drafts the trust agreement, but you should have your accountant involved early on to evaluate your situation, make sure that a family trust makes sense with respect to your income and your goals. Certainly, as we mentioned, there's costs in administering these things, so it may not be the perfect thing for everybody. And then you may also want to have financial planners involved in terms of, again, what assets are going to be in there and how will they help you determine what assets it should invest in, especially when it comes to things more like stocks and bonds and assets that may be held in a brokerage account. Then you'd probably have a financial advisor involved at that level. So the steps in creating a trust, draw up the trust agreement. So again, that's something that's done by the lawyer, by me. You make the initial gift. So this has to be an irrevocable gift. The settlor cannot take it back. As we mentioned, the attribution rules dictate that you should have the asset be either a promissory note that's repaid once the trust has income or other assets have been given to the trust. You can put in a precious metal, silver coin or bar, or it can also just be a cash gift by the settlor. As I mentioned, you want to open a bank account for the family trust, at a minimum one bank account for the family trust, because you need some place to put that initial $100 or $500. It should be put into the bank account, which should be opened as soon as the trust is formed, so that you have that paper trail to present to the CRA in the event that there's ever a challenge. The CRA is going to want to see, okay, where did that $500 go? It really should go into the bank account, and then you should be able to track all the income from the trust and all the payments back out of it. You can also open other accounts. So as I mentioned, brokerage accounts being the primary one that you would probably open and make investments through a brokerage account. And then, we're back to funding the trust, which we already gone through the items that you can transfer to the trust or that it can acquire as time goes on.
Perfect. So then the steps for making the trust, basically just have that trust agreement. So talk with your partner or whoever's our beneficiaries. So plan that ahead and get a good lawyer like Joel. So make an initial gift and open account, so bank account for the family trust, and fund the trust. Decide what you want to just put in the trust. Joel, I have a question here. If you are having a partner who is in the higher tax bracket, so how do you plan regarding the trustee and beneficiary here? So and if you have a spouse in the lower tax bracket, so how you plan? So does it change any kind of in anything regarding how to draw the trust agreement?
Well, typically you're going to want the distribution provisions to provide that the trustee has discretion whether to distribute income out to, using yourself as the primary trustee and you're the sole trustee, you're the primary beneficiary. because it's really your income you're trying to flow into the trust initially, right? So the trustee has discretion whether to flow that income out to you or to your spouse or to your children, or the trustee, again, yourself, you have the discretion to flow income out to all three of you. So as I mentioned, if you have a spouse in a lower income tax bracket and kids who have no or little income, then with your accountant's advice, they may advise you to flow income out to them in order to minimize the tax that is paid on that income. Again, the rules have changed quite a bit recently, so there's less opportunity there for tax savings. But that is kind of the approach you would take. And again, that's also why I mentioned having the corporation owned by the trust, so that you have two levels of timing and ability to control when those distributions are made.
Thank you very, very much. Thank you for just really detailed explanation about everything. It's mind-blowing even for me. I went through it. So I thank you again for the time and for generosity. If you don't mind, I will share the document with the group of physicians. They have been interested in this. So, thank you very much for your time. Have a wonderful day.
Thanks, you too. Take care.
Bye.